What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey. I'm joined by Stephen Gregory, Head of Quantitative Research at Piper Sandler.
Michael, I'm excited today. We're going to talk about the tech sector. And you and I and many of the people on our team are very much tech nerds, I would say. So this is a fun conversation and I'm really looking forward to it. But before we jump in, you and I were talking a little earlier about a little tech project you have going at home, setting up a home assistant account, which I thought was so interesting to consolidate your smart devices, because I was looking at my phone. I have 9 apps that all do one thing, and I always forget which one turns on the lights and which one closes the garage door.
Yeah, no, that's a problem too. I have a bunch of Z-Wave switches and outlets in the house. I've got some that are Wi-Fi and then different products. I use SmartThings, which is Samsung. And I think actually they've recently sold that product to another company, or it's been renamed. And I have a Lutron hub. So yeah, there's like too many hubs, too many apps, and trying to get my kids or my wife to understand how to turn a switch on and which app to go to it's just a losing battle.
So the home assistant just consolidates all of these different devices.
Yeah, it's free software. It's you need a little bit of tech IQ to get it set up in your home, but yeah, it's pretty cool. It's custom. It's like a custom create your own app basically, and it does something that I don't believe any other app does, certainly out there in the consumer retail world, even Apple. It pulls in pretty much anything into one platform. So across multiple brands, across different methods, whether it's Z-Wave or Wi-Fi or Bluetooth. And so you can get your smart devices in your house talking to each other, which is something you really can't do easily or without bringing in other apps like If This Then That, or even some of the broader smart device managers like Apple or Google don't necessarily allow inclusion of everything out there. So it's pretty cool software.
It's great. A lot of these things are supposed to make our life easier, and it ends up search around for what app opens all these and scroll through the pages and pages on your phone of apps. I definitely want to dig into it.
But these things are double-edged sword though, because the more customizable they are, which is great, but then you go down a rabbit hole trying to perfect it, and you can end up wasting a lot of time for unnecessary bells and whistles and customizations. But you and I like doing that, so
it is fun. I love solving problems. That's what we do. That's why we're in the research game. We like digging into things beyond just the surface. And speaking of which, pivoting to the market, but also on the topic of tech, we have just passed, for the tech sector, the size today is larger than it was in the tech bubble.
You were talking about the weight of the tech sector in the index, right?
Yes.
Which is this imperfect measure, because I don't know who has the authority to label sectors or stocks and determine which sector they're in, but the lines are getting pretty gray these days. Amazon's obviously not in tech. Google's not in tech. Is Google in tech?
No, Google, Meta, those are comm services. Yeah. Tesla and Amazon, discretionary. So I think together, those 4 names, which most people would consider tech companies, add up to over 10%. And then you would tack that on the existing nearly 35% that tech is, you've blown past the peak of the tech bubble.
But again, that goes to the issue of these sector groupings, which are far from a perfect way to categorize all these names. So sometimes you're looking at sector relevant performance, or in this case, like the weight of tech. It's not really apples to apples, but it's fun to talk about nonetheless.
Absolutely. I mean, this has been just a incredible run we've seen. And it's not just this year, post-COVID. It's been nearly a decade now where tech has just consistently outperformed. If you line up 10-year cumulative returns for all of the sectors, there's such a gap between the tech sector and everyone else. It's pretty amazing.
Yeah, it certainly stands out. And, the big difference You keep hearing people talk about 2000 and tech's in a bubble again. And, there's certainly data that you can compare today to back then that looks somewhat similar, but, the earnings backdrop is just completely different. One of my favorite charts that we often look at is the relative valuation of growth to value, which essentially is certainly today tech to everything else as it was in 2000. And we look at that relative valuation and seeing if the relative earnings are explaining their relative valuation in tech or in growth. And, unless you've lived through the 99, 2000, those last 2 years of the tech bubble, or have studied it, or both, like us, you may not remember that maybe the last 18 months of the rally in tech stocks was really led by the highest beta companies more often than not without any earnings. So you saw a huge disconnect in 1990, I think beginning in 1998, right after the Fed cut interest rates in response to the LTCM implosion. And you saw this big disconnect between relative performance and relative valuation of tech and the sector and the relative earnings. And they certainly, the earnings did not keep up, but really what was driving that performance in 99 and 2000 was the expected earnings, not the realized earnings. Whereas today, of course, expected earnings are playing a role, but the relative valuation and relative performance of tech that's been so strong in the last decade and certainly the last 3 years has absolutely been explained by relative earnings. And, if it's a bubble, it's an earnings bubble. It's not a valuation bubble. That's a pretty big contrast to what we saw in 2000 and 99.
Yeah. One of the other things I've been super surprised by is most recently. So from the April bottom, where it's definitely been a lot of beta, a lot of lower quality names in this kind of relief rally, the best performing sector has been tech. It's been this weird kind of barbelling aspect.
Tech can't hold tech down. Or what was that song from the late 90s, early 2000? I get knocked down, I get back up again.
Yeah.
Yes. So, Oompa Loompa or something, Oompa Loompa. I think I saw them actually live in concert at the first Jingle Ball in Madison Square Garden in the early 2000s. Chumbawamba?
Chumbawamba Tub Thumper. Or
Chumbawamba or something. Yeah. But yeah, tech didn't get knocked down, that's for sure. And but if you think about it, it's been the same story for the last 3 years. In these big up moves in the market, you get broad-based multiple expansion as macro relief sets in. But if you've got multiple expansion plus really strong earnings, the math says you're going to outperform. So that's certainly why tech has done well. There's really been very little doubting of the earnings backdrop, whereas outside of the tech space and the Mac 7, there's a lot more uncertainty, a lot more near-term uncertainty, at least, without a structural bull case like all the AI areas of the market have. So tech's likely to keep outperforming. I'd say that, when we think about the risks to tech as a sector, I'd say it's twofold. It's one, if you get a big idiosyncratic, AI collapse and the expectations around that, NVIDIA comes out and says, oh, chip demand is collapsing. Or, and this is the more positive version of a potential rotation at tech. And what we did see a little bit this week, but I think we've seen it 6 or 7 times and it hasn't been sustainable, is a rotation out of tech into the rate sensitive trade and the small cap trade and the housing trade, basically everywhere else that's been underperforming and negatively impacted by higher interest rates over the last few years. I think that's less likely to happen in any kind of strong way, but we keep getting these fits and starts and head fakes, when we get rates to come down in the market to anticipate a Fed rate cut, whether it's because of weaker, softer inflation or even higher unemployment like we saw in the most recent employment data. But if it doesn't come from lower inflation, then higher unemployment driving interest rates down doesn't really make me excited about owning small caps. So I think there's a little bit of a double-edged sword in that outlook.
So what you're talking about is your more classic, full-fledged recovery where housing, rate sensitive lead the way, and you get a leadership change.
Yeah, exactly. And just quickly taking a sidebar from tech and into small caps, the issue with small caps has been the last 3 years has been no earnings growth. It's just been down and down. It hasn't collapsed, but it's just been kind of a flat to slightly lower backdrop of realized earnings and high earnings expectations I don't know, 12 quarters in a row have just been knocked down day after day, month after month. Here's a conundrum. Maybe you could figure it out. When you look at small cap earnings, they correlate pretty well with interest rates, which makes sense. Rates go up when the economy gets better, rates go down when the economy gets weaker. Small cap stocks are very sensitive to the economy, and their earnings are obviously extremely pro-cyclical. On the flip side, their valuations of smaller caps at times get beaten down when rates go up and do exceptionally well when rates go down, as we saw earlier the past week when we got a good CPI report, at least the way the market reacted to it. So putting this together now, it's a bit of a conundrum because you need better growth to get broader earnings participation, but that's going to come with a side of higher interest rates, and higher interest rates is what is preventing the broader pickup in small cap earnings. So it's a bit of a circular loop. So either rates kind of stay where they are and we just slowly come out of this, as has been the case, and small cap earnings eventually pick up, but not in any kind of V-shaped or strong way anytime soon, or you get a recession and rates come down a lot, then eventually you get a sharp, broad rebound. Or if rates move higher, small cap multiples likely come under pressure from that higher interest rate backdrop. So it's a bit of a conundrum for that part
Yeah.
of the market, and
That's
for rate
the
sensitives in general and housing as well.
that's the reflexivity cycle you've been talking about in your
Yeah.
work, where and all of that goes into this range boundness we've seen in a lot of the underlying economic data. You get too hot, come down, too cool. And these moves we've seen in a lot of these stocks, to your point, hasn't been because of earnings, macro uncertainty, and it's all been PEs expanding and contracting. So
Yeah.
what breaks that cycle?
Yeah, exactly. Which to me is why right now, just at the time where I think people are starting to get excited about small caps, as they do every time, they outperform for 4 or 5 days. I think it's not a great risk reward with given where credit spreads are, given where basically the pricing of macro risk in the market is almost zero. And I was listening to Bloomberg yesterday in the car, and somebody was being interviewed and talking about small caps and made the case that small caps are not discounting as good a macro backdrop as large caps are. And I guess they were speaking to the fact that small cap PEs are lower than large cap PEs. And of course, tech is a big part of the reason large cap PEs are where they are, their profit margins, et cetera. But I would very strongly disagree with that sentiment that small caps are not pricing in a Goldilocks backdrop. Their multiples are at the high levels or high part of the range they've been in the last 5 years. Their multiples have gone straight up since the market lows of September, October 2022. And they're up pretty much for all intents and purposes, exactly as much as large cap PEs are in the last couple of years. So they are very much, if not arguably more, pricing in a Goldilocks picture perfect macro backdrop. The fact that their PEs are lower than large caps doesn't really give you, in my opinion, any information on that. It's really about the change. PEs are lower in small caps, of course, because the index is more cyclical and lower quality, more debt, more risky. So, something more risky should have a higher equity risk premium and vice versa.
Yeah, people often look at the absolute levels, but they do tend to move monotonically together. And
Exactly.
the differences are more explained by composition and expand and contracts between them over a very long period of time. I think it was a chart you were showing, I think this week, where, as you mentioned, large, mid, and small multiples have basically been percentage change, the exact same over the last, since 2002, almost to the penny. It's crazy.
Yeah, because at the end of the day, the short-term moves in market multiples are all just reflections of macro and macro sentiment. And they all went down a lot in 2022, and they all have gone up a lot since. They all got hit during tariffs. They've all recovered since. That's the impact of macro in markets. Its valuations reflect that. Now, the relative earnings help to separate beyond valuations and winners and the losers. So my point about today not being a great risk reward for small caps, unless you believe we're going to keep going down the road of Goldilocks, and we'll get this picture perfect rate cut backdrop because of inflation coming down, you're probably not going to see small caps outperform if PEs stop going up, and for large caps too. The irony here, if you're worried about large cap valuations, it's small caps you want to avoid because large cap valuations are only likely to go down if a macro risk begins to get priced in. If that happens, stocks most sensitive to macro, not the most expensive names necessarily, but the lower quality names are going to be most likely to get hit. So, and without a strong earnings backdrop for small caps, you're kind of left with a story that may plateau until you get another broad macro upswing, macro driven upswing in markets.
So I have a question. So tying in how we started today, talking about the tech sector and how tech is the only game in town. Now we've been talking a little bit about size differences and fundamentals. What differences do you see, and are there any, between larger cap tech and smaller cap tech, and maybe even tech around the world? Is it all the same?
Sure. Yeah. Well, this is another good example of why talking sectors is not the best way to communicate an investment thesis. Because if I were a mid cap and small cap tech, small cap portfolio manager, I'm missing the boat. Small cap tech stocks have, in a really ugly way, underperformed the markets in the last 2-3 years. Mid cap tech stocks have underperformed the S&P 1500, small cap even worse. And all at the same time with the large cap tech stocks have gone up tremendously. And again, it makes sense why they've underperformed. We look at small cap tech profitability metrics, they're near zero. Mid cap tech has kind of been hovering around 4% in terms of ROA in the last 3 years, while large cap tech has gone from 10 to 14% since the beginning of COVID. So this is not really about tech as much as it is about the companies within that tech sector that have good fundamentals, which is to say that it's got really nothing to do with tech as a label and has all to do with just very rudimentary financial statement analysis of improving sales growth, profitability, and earnings. I don't care what they do. I don't care if you make widgets or if you sell widgets or you move widgets, you broker widgets. I just care about how profitable you are. Goes to the point of, you often hear from technicians, they can evaluate any line on a chart, irrespective of what that line is, whether it's an interest rate, commodity, the stock market, because all of the information they need is in there. And similarly, we do the same, but from a quantitative fundamental perspective, having a view on the macro backdrop and the market backdrop and trying to figure out what types of attributes investors are going to seek out. The last 3-4 months, of course, investors have seeked out higher beta stocks because the market had such a strong rebound after a big sell-off. But looking back over the last 3 years, the market's consistently been seeking out names that have had strong high levels of profitability, strong earnings momentum, high levels of free cash flow. And so when you go down to small cap tech, you don't really get much of that. And even when you go around the world, you don't get much of that either. Tech has not performed in Europe or Canada, Japan nearly as well as it has in the US. And again, it's really due to the fundamentals of the stocks here, not just because you're a tech company. You hear about recently, you're getting all these names that are, becoming crypto names, boom, the stock goes up. Maybe this was the case in 99 with the .com label, but today, if I change the name of my company to just say tech in it, there's really no excitement around there. If you say AI, maybe you get a little bit of a bump. But at the end of the day, the markets are rewarding companies that are producing results, basically. And that's a key difference between today and what you saw in 99 and 2000.
So the answer to the question of, is tech the only game in town, really needs an asterisk, that it's US tech and it's large cap tech.
Large cap tech. Yep.
It continues to be, for the better part of a decade, a line straight up. Nothing moves perfectly every day. So it gets knocked down, but it gets right back up again because it has the fundamentals underlying it.
Yeah. For small cap managers, it's been really industrials and financials that have done well this year. Tech, I think, in the S&P 600 small cap index is basically flat. Meanwhile, the Mag 7 are up a lot. So, what stock pickers and portfolio managers can do in this environment, let's assume you already have enough tech. And if you've owned tech, that's only become a bigger share of your portfolio. When people talk about the index seeing increased tech composition, well, that's the same thing for everyone's 401k, their brokerage accounts, et cetera. And so to diversify away from some of that tech, if you're looking to rebalance or just looking for other names that are not as correlated to the same story, I think recently people are saying, oh, it's time to buy small caps. or housing, which certainly would require interest rates to come down. But what if they don't? Well, then you want to look for attributes that these tech stocks have. And again, what is it? They're cash flow profitable, positive earnings momentum, sales growth, high profitability levels. So if we look at those same attributes and we look at the industrial sector, the financial sector, discretionary sector, there's plenty of names within those different sectors. Again, we don't care about sector labels. We care about fundamental attributes that fit that same type of recipe that some of these really strong tech stocks have.
So focus on the attributes. They're really the driver behind that, and it doesn't matter as much the S&P, MSCI, GICS sector label that is thrown on it.
Yeah, I think it's just, especially as some of these larger companies just get larger, it's easy to categorize a company when they're small and kind of, have one vertical of business, but think about Amazon today or even Walmart recently in the last decade or so, they cross many different lines. And I remember like GE back in the day, right? They had a financial component, they had a aerospace component, defense component, insurance component. And so that was kind of one of the, at least in my lifetime, one of the names that was harder to categorize. But I guess industrials is a bit of a catch-all too. So maybe we should just call these stocks industrials.
Yeah, there's definitely a lot of industrial stocks that, in the robotic space and innovation and just really strong fundamentals.
Yeah, well, in the whole data center built out, you've got all these construction companies that are, just don't get as much media or press. And there's a couple names that are up a lot more than Nvidia this year. And, they're kind of derivatives of what's going on in Nvidia. And the more chips Nvidia sells, well, the more data center needs and energy needs, they'll likely be as well. So obviously that's a derivative on the same story. So that doesn't diversify you as much perhaps as just looking for names in general that are just doing well in this macro backdrop that are not necessarily AI driven. Because again, just adding more AI related stocks doesn't really diversify you.
Utilities. That's an
Sure.
interesting one. I mean, it's had an incredible run. You and I have been doing this a long time. You ever heard people talk about utilities before?
Well, not in the risk on, speculative, high expectations way. No, that's for sure. They've gone from one end of the spectrum, not all of them, but certainly many of them, to the other end of the spectrum in terms of safety versus risk. And, I remember a year or two ago, we were talking about the utilities sector as the Iron Man sector because there were many macro and market outcomes that sector could work. If interest rates come down, utilities has a high dividend yield, so you tend to see investors flock there. If credit spreads widen, utilities is a great space to typically be in when spreads are widening. And then the AI trade is certainly driving many of those names as well. So you've got a lot of different variations where that sector can work. And, it's certainly done much better than something like healthcare or Staples, which is, we could talk about Staples, just a very consistent counter-cyclical name where it's kind of a one-trick pony at least from a macro perspective.
Yeah, healthcare is the only sector with negative returns off the April bottom. That
Yeah.
sector just can't seem to get out of its own way.
Well, it may get a boost. We saw this week that Berkshire Hathaway is buying United Healthcare. Appaloosa did buy United Healthcare. So for those that have been deep sea fishing in the healthcare space recently after a lot of underperformance, that will certainly, at least in the near term, create some optimism. But when we look at healthcare and, there's been so many single name blowups in that space and some big names like Eli Lilly that have kind of come off the high expectations horse. When you look at healthcare from a very simple cyclical perspective, healthcare is doing what it should be doing in a backdrop where credit spreads have tightened, which has been really since the lows in the market in 2022. Healthcare is not an area to be in when macro risk is getting priced out of the market. It's quite the opposite. So, and that's a space you probably want to remain somewhat selective in, unless you're bearish on the market or, think we're going to have a negative catalyst that pushes spreads wider.
Interesting as always, Michael. Thanks for the time. And market always keeps us guessing with new twists and turns. So until next week, thanks.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.